Video you are going to need when it comes to A+ entry setups. After this video, you should not be on YouTube searching up how to enter a trade ever again. After this video, you should not struggle with finding an entry at a higher time frame key level. If you do, it's because you didn't take notes, you didn't watch this twice, and you were probably multitasking whilst watching it. So here's the rule for this episode. Put your phone away, put it on silent, put it on do not disturb. Tell your girlfriend or your boyfriend or your husband or your wife, leave me alone right now. I'm trying to master something that's gonna make sure we never have to go to work again, because we're gonna make millions from this skill. So buckle in and pay attention. For me personally, there are 4 A+ setups to use, but there is one that is the highest probability and is better than the rest of them completely. And that is obviously my favorite, which is the IFEG. However, there are 3 others that you can use. First, you have the IFEG, which in this scenario is telling you that there is a sell side redelivery to the buy side liquidity. The IFEG is the first confirmation and the earliest confirmation and the highest probability of confirmation in a trend change and the change in the state of delivery. Then you have the breaker block, which the breaker block firstly confirms the order block that forms, then it confirms the IFEG that formed, and it also confirms a market structure shift, and it also confirms a dealing range. So you can always expect that in this case, when you see a breaker block, it's quite simple. You are 100% going in the opposite direction. Okay? Then you have the discount and premium and OTE, which are practically the same. The only difference is the OTE starts at 0.7% to 0.79 and 0.62%. That's the optimal trade entry. First, you would need a breaker, then you would need that retracement into the OTE. Okay, you can also couple it in with a PD array, in this case, which would be a discount key level, and you would enter. I'm going to show you all 4 of these setups. Of course, the same thing. You buy in a discount when we're bullish, and you buy in and you sell in a premium when we're bearish. Simple. Okay. Let's continue. Let's find a easy setup for the day. Okay. We'll use, let's use this candle right here. As you can see, we filled in a fair value gap on the daily time frame. So we're going to expect lower prices. So how can we do that? We'll enter on the 15-minute. Now on the 15-minute, here is how to determine and confirm an A+ setup. First, you need a stop trade, liquidity sweep, redistribution. In this situation, because we're bearish, it's an accumulation, a reaccumulation, or offset accumulation if we're bullish, and it is redistribution and offset distribution if we're bearish, which is simply a form of order pairing between smart money, short positions and buy stops of retail, or smart money long entries being paired with retail sell stops. Write that down. Okay, we have the stop read, which is a sweep. Stop losses have been taken. Then we have, first thing we have, let's take this back. The first thing we have is the IFEG has formed. And that's your first confirmation of a trend change. You can enter right here. IFEG, that's your first entry. Then we have a breaker right here. A breaker is comprised of a high, a low, a higher high, a lower low. So here's your breaker right here. See that? And you could have entered aggressively here, or you could have waited for a retracement to the breaker, which didn't happen. Now, there's also another breaker right here. Why? As you can see, oops. As you can see, we have sweep. So a high, a higher high, a lower low, a low. Let's get a high, a low, higher high, lower low. It's your breaker. And there's two ways you can enter a breaker. You can either enter a breaker aggressively when it closes below. You could have this one wick. You don't actually need a whole retracement. This one wick alone. That's your breaker block. That's the second A+ entry. Okay? As you can see. Tapped back in. And we've gone back down. The next, based upon this market structure shift, which is a breaker that confirms that, you can mark out the premium and the discount. And you can simply just buy, in this scenario, you can simply sell when price goes above the 50%, which is the equilibrium. So you can expect for people to sell at a premium because price is too high. It's quite simple. It's too high, it's too expensive. So you might as well sell. And that's the same way in a discount, you would buy anything in a discount. It's like Black Friday sales, for example. Okay? Perfect. And then you have the OTE. See that? You will sell at any state as long as price goes above the 50%. If it taps into the 0.62, it's even perfect. If it taps into the 0.7, it's even more perfect. If it taps into the 0.79, that is a huge sign that you're going to see a huge expansion in the opposite direction. But remember the steps. It's a 4-step process, and that 4-step process only includes the steps of a breaker block, which comprises of a high, a low, a higher high, a lower low. Then from there, you can either look for IFVG, which IFVG is the earliest confirmation as you saw, or you can mark out the breaker, enter based off once the breaker has been formed, you place your stop loss at the high, or you mark out the Fibonacci tool and you enter above the 0.5% at the 0.62 to 0.79 levels, or you use the GAM box. Oops, done it the wrong way around. Or you use the GAN box and you enter above the 50% at a premium in a bearish market. And of course, if we were bullish, you would enter below the 50% in the discount. And you can also validate that by finding a PD array if you would like to. Also, whilst we're here, I'd like to teach you that every PD array can be inversed, not just an IFVG, not just an FVG. This right here is an inversion breaker. See that? High, low, lower, low, higher, high. Just get. Anyways, that's that. Those are the 4 highest probability entries that you can use. Entry models that you can use. It's quite simple. Another key tip. Let's type that out. Key tip. You know what I like? I like the authenticity of these videos. Let me stop talking. I don't know why I said that. Okay, key tip. Never, and I mean never, let the distance between your entry and your stop loss determine your RR. Let the distance between your entry and the drawn liquidity, right here, determine your RR. Okay? That's how you validate it. The mistake I used to make earlier on in my journey is, oh yeah, but if I place my stop loss here, it's gonna be a measly, let's say this was drawn liquidity, right? If I place my stop loss here, I'm only gonna do a 1 to 2. Well, that's for you to invalidate it and say, well, that's not a valid trade, I'm not gonna do it. But to never let, oh, you know what? Let me bring my stop loss here so I get a 1 to 3. Because then you're trading based off of emotions rather than logic and mechanics. You have to treat the market like it's a computer and everything is an if-then situation. Do you understand? That your stop loss needs to be based upon where is price least likely to go before drawing towards where it's most likely to go. And it has to be logical. Logical based upon where were the stop losses taken. That is where your stop loss should go, because there's no more liquidity there and you shouldn't be expecting for a retracement. You let the distance between your entry and the drawn liquidity determine that. Your RR, which you should be aiming for a fixed one of 1 to 3. Okay, right here. Voila. That's it. Okay. Like, let's say, for example, you were entering here, and then you said, oh, no, but my stop loss is going to be, I'm going to only have a 1 to 2. And you said, okay, let me move my stop loss like here. Let's just move it here. It's probably not going to go there. You would have got stopped. Hold on, let me do it for realistically. You would have got stopped out for absolutely no reason other than the pure fact that you were being greedy and you were being emotional. Keep that in mind. Is there anything else? No. That's all. Actually, let me add to the key tip. Notice we used a daily and then we used the 15-minute. That's the two-step process of using the daily range and use the 15-minute market maker model. In this case, it was the market maker sell model to find entries and validate that higher time frame range, because the lower time frame is always building and validating the higher time frame range. But you still determine the bias using the higher time frame, but that is a hypothesis. The way to test that hypothesis and confirm that your hypothesis is right is by using the lower time frame. And once you see an IVG, in fact, once you see a stop rate, then you see an IVG, that's your first confirmation. Then you see a breaker, that's your second confirmation, because the breaker confirms the IVG and the order block that had formed. And then you can use your OTE and your discount and premium. And that is how you validate a higher time frame range, by using the lower time frame. Okay? God bless. Also, the free training, let me add that in since I'm here already. Actually, that's fine, never mind. But the free training is simple. The alphafx.co.uk, go and get the NQ model. God bless.